How's it going, guys? This is Forensic Forex with Deontay, and I'm back with another video. Welcome to July. This is your first daily update for gold versus US dollar. This is the second time I'm tracking gold this year for a month. I think I did gold in February. Now I'm doing it again here for July. At the end of every month, the last week, generally, I post a poll in the channel and allow you guys to vote, and whichever one wins, that's what I track for the rest of the month. And if your pair didn't make it on the list, too bad. That's just how it goes. I only trade certain currency pairs. I'm not going to trade a currency pair I don't trade. That's just how it is. I trade the majors mainly. Here, we can see I'm using IPTA data range, so we're not going to waste any time. I look back 20 bars, 40 bars, 60 bars. I find the highest high and lowest low in each one of those quadrants. You can see I have dollar signs above the highs that are unbroken and dollar signs under the lows that are unbroken. That's going to be my buy side. And that's going to be my sell side. These are going to be the levels I'm concerned with price rating, because price is normally going to be drawn to liquidity. Now, we do have highs or lows that are already broken, and we can see many lows here that are broken. These are still going to be significant to price because there could be a reaction around that old low. Now, the fact that I'm using IPTA and being a little more experienced using it for a couple of years now, I know that these lows can be significant in price action, whether it acts as quote-unquote retail support and resistance, break retest, whatever the case may be. There's going to be some type of setup that happens along the lines of these old lows. It is still a PD array. It's an old low. It could still give it a reaction. We have July's opening price, and we know the ideology behind this. When price drops below July's opening price, that's a discount, right? It is now oversold, high probability buy scenario, especially if the trend is going to go up. Same thing, vice versa. Anything above July's opening price is a premium overbought, right? It's at a higher value, most likely going to get higher probability sells here. Now, a very simple macro that I use is my seasonal charts. My seasonal charts will gauge me in whether or not I should be bullish or bearish for the month. Here, we can see for July, gold is bullish, and it's a good sign to see that DXY for July is bearish. So they're inversely correlated, and it's good that the seasonal charts are also showing that as well. So it may exacerbate a trade, right? It might make things a lot more crispier, if I would say. I'd rather see dollar going down and gold going up instead of gold and dollar going down for that month. Then I would probably not want to trade gold, because that's not a confluence I want to see, right? They should be moving inversely, and I need to pick certain times of the month where they are clearly showing signs moving inverse, and July is one of those months. Yes, the seasonal charts are not going to be the end-all be-all to your trend or your daily bias or weekly bias, because there are some months where price does not follow seasonal tendencies. I speak about this in a very earlier YouTube video. I'll leave the link in the bio or something, but you'll see that price action is normally going to be your best friend. So if we're speculating gold is going to go higher, I would like to see some type of swing low formation form below July's opening price, and it be higher than this swing low. If not, I would like to see the 20-day low rated, and we create a low in July, and then price goes higher. Something along the lines like that. If not, you could see price come here, respect this low, not break it, and move higher. And if I see a swing high broken, I will just simply wait for a higher swing low. That's how I gauge bias. That's always my to-go-to way to find the trend. Now, if dollar is going to go lower, the inverse should be said. And let's take a look at dollar. Get the opening price. It's here. And we'll just leave it as a dashed line. We'll move this out the way. This and this. So this line here that you just saw with the premium and discount, that's just me taking a fib tool, measuring this low to this high. So this swing low to this swing high, that's the range that dollar is currently trading in. I measured that, and I cut that range in half, so we can see that price was currently in a premium or overbought territory. You see how price came back down into a discount below it here, and there was some type of rally or buying sponsorship here, and we're back into a premium again, crossing this line here. So like I said, I'm just taking the 50% range of this low to this high, and that's how I got that premium to discount level. Here we got the opening price, same idea. If price moves above July's opening price, we're in a premium. I would like to see price create a lower swing high or a swing high above the opening price and then price going down. That's what I would like to see here. All in all, I would like to see price get down to these equal lows here because there's sell side liquidity below it. That's why I have the dollar signs there. And we can see price is at the 60-day high right now. So there's some type of reaction here. See price trade down into it and then it rally back up. So there's some indecision. The first week of this month is going to be NFP, right? Non-farm payroll. Normally, I tell traders not to trade it if you're not experienced trading that. But if you are a little experienced, you take your small setups. I don't look to find huge swing setups here the first week. Normally, it's the second week that I normally look or plot to find a swing setup. It's normally the second week. Sometimes it may be the third week, the fourth week. But generally, the second week is normally where I'm looking to find a swing position because that first week normally is going to just induce a lot of the retail traders to the wrong side. And then the commercials are going to let it fly in the direction that they want it to go. So if price were to come up and take out this swing high, I would like to see that as a false break because if the narrative is price is going to be bearish, you rather see price raid buy side and then sell lower. That's what I like to see happen here for DXY. That's my most simplest explanation here. I don't have to go any further into this. However, if we were to look at what the sentiment is from a retail perspective, what I generally do is I just go into TradingView. I look at gold, right? And this should be a different gold. I don't want to look at gold at this. Actually, yeah, Oanda. I think their liquidity pool is more, what's the word? More closer to the true price action. Where is it at? There we go. So we're looking at the ideas. And we can see, oh, I switched it back to FX. I don't know why. We could see that the sentiment for retail currently, right? You can see a lot of people are saying what? Shorts, right? End of the month, 5 hours ago, a lot of people are saying short. There may be a few longs, but I could see that generally the population is, the community at least, is predicting that gold is going to go down. And generally, if everybody's saying it's going to go down, it's not going to go down. Odds are it's going to do something completely different. Now, another macro perspective that I would like to take here, right? I would come here. I will go to commitment of traders report. I'll come down to the short format here for metals. And then I will just type in gold. And then I'll look at the managed money. So the managed money is going to be the commercial specs here. And I'm going to look for the longs and the shorts. I can see that the longs are outweighing the shorts right now. So the commercials have a hefty long position on gold right now. Does that mean gold needs to rally? No, because many people get that confused when they look at the COT report. They think that, oh, the COT report says that the longs are higher than the shorts, so price action needs to reflect that as well. That's not true because the commercials also have a hedge program. They could be showing that they're heavily long, but on the flip side, they're actually shorting. And price action will break down. You'll see that time and time again. But right now, if we were to take the longs minus the shorts, we're going to get a positive number. So we can say that they're net long. Just a quick approach to finding some macros. I would like to also see if correlated pairs, right, are also going to go down. So for instance, if gold is inverse to dollar, that means GU, AU, NU, and AU are directly correlated to gold. So if gold goes up, foreign currencies go up as well. So if we look at, let's say GU, we want to see price action show some type of resilience to go higher and follow gold as well. Same thing for AU. We want to see price find some type of momentum to go back up bullish. But if it's not showing those signs, then I will have to take a different stance with gold. And sometimes there will be SMT divergence. You'll see that gold is going higher, but AU, GU, or they're not going high either. That means maybe gold is just being pushed up to be short heavy, right? They're ready for a heavy distribution. And that's generally what I'm using to speculate whether or not the pair that I'm looking at is going to go up or down. Same thing here. If I had to take inversely correlated pairs with the dollar, if I want gold to go up, UCAD has to go down. UCAD must go down as well. Same thing with USWSI. I want to see price action break down lower. And we can see right now they're building up for something. You can see price action is stalling. Are they stalling to build up net longs, or are they stalling to go short? And just to take a look at the 2-year bond market, because this is something as well I use to gauge with the dollar. So we got the yields going up, right? And we can see we haven't got back to this point in a long time, actually. So this last up close candle before this drop all the way down here, you got this liquidity void. Not to say he needs to fill it all the way, but we can see we're definitely filled in a great portion of that liquidity void here. Is this inverse to what stocks are doing? Because if the yields are going up, S&P should probably go down, because yields go up, dollar goes up. And if dollar goes up, stocks go down. That's the way it goes. When dollar drops, stocks go up. That's generally the correlation I see when I look at the pairs here. So I'm using a lot of different moving parts to help me speculate what gold is going to do. And I've done this time and time again, as you see with the daily updates. It just takes a little more experience and a couple more years underneath your belt to understand how these markets move. If I look at the S&P, right, SPX, we can see it's still going up. Up. We've been noticing Apple just broke all-time highs. Meta's been going up. Nvidia has been flying. A lot of things have been going up, especially in the tech sector. Not to deviate from FX, but these markets help each other. And it's a good idea to pay attention to them, because if you see stocks rallying, that means dollar most likely is going to drop and gold is going to rally. Foreign currency is going to rally. If you see the S&P and stocks dropping, that means dollar is going to rally, UJ is going to rally, UCAD, USWSI, dollar is going to gain more strength, yield is going to go up. But the fact that I see S&P up and the 2-year yield up as well, there's a problem there, right? There's an S&T divergence going on. So one of the two is lying. S&P shouldn't be up if yields are up, and the same thing vice versa. Yield shouldn't be up if S&P is up. So one of the two is lying. And we're going to find out within the next couple months whether or not the S&P is going to tank or it's going to continue to rally and progress going higher. And dollar is going to continue to be devaluated. So there's a lot of moving parts to this. Hopefully this was insightful. I'm going to keep it short and concise. I'm literally telling you what I do, right? And hopefully it makes sense. I know for some people, they may be thinking, is there more to it? No, there's not more to it into my strategy here. Now, from a very basic idea, right? If gold is going to go up for this month of July, I'm going to wait for every down close candle and I'm going to buy after it, right? We're going to slowly compound into buying gold. If July is supposed to be quote unquote the seasonal low, or going to make a yearly low or monthly low and then rally for the rest of the month or the rest of the year, all we have to do is wait for down close candles and buy. And we're going to talk about that in a separate video on entry techniques using stop or limit orders. So hopefully this is insightful. Looking forward to tracking another pair with you guys again. Peace.